A very good morning, good afternoon, good evening, or good night at whatever time you're watching. This is CA Thofik Tufel, and today I am coming up with an introduction to paper 20A for CMA final, and that is an elective paper which is strategic performance management and business valuation. Sir, why are you here? I'm here to give you some exciting news, some announcements, and a demo lecture of SPMBV. See, in the market, there are very less people who cater only for exclusively for CMA students. So, as also discussed in the previous video, THARUN'S sir has gotten the initiative to exclusively cater also to CMA students and also to CA students separately. And I am your faculty for SFM Strategic Financial Management and SPMBV Strategic Performance Management and Business Valuation. You can see the previous video for SFM introduction, and this is for SPMBV. Sir, who are you, sir? Few people will know me, few people will don't know me. So people who don't know, my name is CA Thofik Tufel. I'm a chartered accountant. I'm teaching for CA and CMA at inter and final level subjects of financial management, strategic financial management, and anything related to finance. I am the resource person. Now, sir, I am into teaching from past 2.5 years, teaching with multiple academies, and I'm teaching online only with THARUN'S Brainery. Here today, from the past so many months, we were discussing that we have to come up with something, and finally we have come up with CMA final Navigator program, where this is regular classes for CMA final. All expert faculties will be teaching you the subjects. So you will see all the other videos in the YouTube channel. Today we are focusing on SPMBV. Sir, SFM, the video is already out, you can watch. So we are focusing on SPMBV. So you can purchase the entire program also, or if you want to purchase only my class or only subject wise class, you can also purchase it. The link is in the description. Now, or you can also call the numbers so that you will get the more details about the courses. Sir, what will be the timing, sir? The timings are Monday to Friday morning 6:30 to 9:30 and Saturday and Sunday 7 to 1. So only Saturday and Sunday we will be taking till 1. Otherwise we will be taking from 6:30 to 8:30. So this is an ideal timing that will not even affect your office timings. So this is the timing, because most of the students were asking either for a morning batch or for an evening batch. So we have come up with a morning batch 6:30 to 8:30. In this 2 hours, it will be a live class, online live class. So where we will be sitting live in Zoom, and then we will be having the classes in a similar setup. Or you can also purchase Google Drive recorded classes if you wanted. So you can have all the other information from the number which is mentioned. Sir, what is the fees? You can all look at the fees here. Sir, when is the batch starting, sir? The batch is commencing from July 10th. So SPMBV will be starting somewhere in August, September. Okay, SPMBV will be starting somewhere in August, September, and this SFM will be starting somewhere in the July end, and all the subjects will be started simultaneously. For a subject-wise schedule, you can always call the persons, and they will be giving you a more detailed schedule for the subject-wise. So this is something about the course. So you can also share it with your CMA final friends who want to attend the classes. Now, sir, let us come into the subject of strategic performance management and business valuation. First, this is an elective paper, okay, this is an elective paper, paper 20A. It comes under the module, where you are having elective papers. You're having a lot of elective papers. The first is strategic performance management and business evaluation, and then you have this entrepreneurship, then you have this risk management in banking and insurance sectors. So those are some of the electives. Based on the past trends, we have seen that the paper for strategic performance management and business valuation is the most scoring paper. I am not telling, RTI is telling that, okay. So we have filed an RTI, and then we have gotten the marks for all the percentage wise marks for all the different electives, and we got to know that SPMBV, it is the paper that actually is a more scoring subject. Sir, what will be the difficulty level? Difficulty level will be moderate, okay. It will not be easy also, it will not be very much difficult also, it will be a moderate, and it's a blend of theory and practical. So people who are very much comfortable with numbers, calculations, logics, common sense, and if you love the subject financial management and cost management, this means this subject is a value addition for you. For an exam perspective, this is the most scoring subject. Difficulty level moderate, okay, not that much tough. And when we talk about entrepreneurship, currently the papers are coming very easy. So if you want very easy papers, and if you're very keen on theory, I want easy language theory, then you can choose entrepreneurship, okay. So entrepreneurship is a generic subject. Strategic performance management and business evaluation is a very structured subject. So preparation is very easy for this subject. Generic preparation will not be easy. Here preparation will be very much easy, okay. So let us come to the strategic performance management and business valuation paper. This comes for 100 marks, and it has two sections as the name suggests. One, section A, it has only two sections, strategic performance management, and section B, it is business valuation, okay. And both are having 50-50 percentage weightage. 50 percentage weightage for strategic performance management and 50 percentage weightage for business valuation, okay. It has 9 modules. 4 modules in strategic performance management and 5 modules in business valuation. Modules are chapters. So we have total 9 chapters. So 4 chapters in strategic performance management and 5 chapters in business valuation. I've even given the weightage for each of the chapters. That will help you for the preparation. I'm just giving you an overview of the subject. First, KYS, know your subject, know your syllabus. Only then we will be moving ahead. Okay. Sir, for strategic performance management, you're having 4 chapters. Introduction to performance management, performance evaluation and improvement tools, economic efficiency of the firm, which is performance analysis, and enterprise risk management. These are the 4 chapters. And when we come to business valuation, we have fundamentals of business valuation, laws and compliances of business valuation methods and approaches, valuation of assets and liabilities, and we have valuations in mergers and acquisition. Business valuation is a very interesting section. I love to teach this subject, and they will be discussing in depth from this subject. And even strategic performance management is also a very interesting, where we will be learning a lot of performance measurement tools. Now, I have also given the weightage, okay. For here, the more weightage is given for performance management, evaluation, improvement, and tools, because all the tools are covered here. And enterprise risk management, this is actually an emerging topic, so that's the reason heavy weightage is there. And if you come here, business valuation methods and approaches, valuation of assets and liabilities, and valuations in mergers and acquisition, this covers 40% of the syllabus. These 3 chapters: business valuation methods and approaches, valuation of assets and liabilities, and valuation in mergers and acquisitions. Very important and very interesting topics. Now, sir, I don't know anything about this subject, sir. What is this subject all about? Please tell me. Okay, you know about financial management, strategic financial management? Yes, sir. You don't know? See that video. Sir, what is strategic financial management? Sir, what is financial management? Managing money. for the business to take strategic business decisions. That is what is strategic financial management. If you remember the steps in financial management, or if you remember the steps in any investment decision that you want to take, sir, I don't remember. See here, the steps in capital budgeting. First, I want to identify the investment opportunity. Second, I will estimate the cash flows. Third, I will assess the risk and time value of money. Fourth, I will apply some evaluation techniques. So NPV, IRR, all these are evaluation techniques. And then I will take a decision. Till here, it is FM. Now, if you see the last part, evaluation and control, here performance management comes into play. Okay. So, what is SPMBV, sir? What is performance management? Performance management is actually after when you take financial decision. So, after the decision making, someone has to see, right, whether the decision we have taken is actually working or not. Let us say, okay, let us say that you took an investment decision. So, you have some make or buy decision. You did all the calculations for make or buy decision. You got NPV positive 1 lakh rupees. Now, since the NPV is positive, you will decide to take a decision of sell, let's say make. Let's say you're taking a decision of making instead of buying. Now, when you're making, 1 month got over, 2 months got over, 3 months got over. You have to check, right, whether whatever you have estimated the cash flows, is it matching with the actual cash flows or not? If it is not matching with the actual cash flows, it means that your decision making would have gone wrong. It means that there is some problem in the estimation. It means that there is some problem in the calculation. It means that there is some problem in the decision making, and had we bought, it would have been better. Understanding? So when these things will come in, now these things comes under performance management. Let's say, sir, I want to make a decision buy or rent. Now you took a decision of buy. Now the buy decision is taken. Now you have to evaluate, right, whether the buy decision that you have taken is actually working or not. Are you all with me? Now, lot of decisions you are going to take in financial management, capital structure decision, investment decision, financing decision. Now, after making the decisions, there is something called as performance management. You have to see, you have to evaluate the performance, whether the decisions that you have taken is proper or not. Sir, when you have to check, sir? When you have to check? After 1 month, after 2 months, after 1 year? It is a continuous process. Continuously you have to monitor. Correct? Let us say that you have estimated that my annual sales will be 12 lakh rupees. Which means on an average your monthly sales should be 1 lakh rupees. If first month sale is 10,000 rupees, how you will achieve the annual sales target? So first month report should say that average you should be earning 1 lakh rupees per month, but you are earning only 10,000 rupees. There is a 90,000 deviation. Now next month you have to fill that gap. Otherwise what will happen? Your annual target of 12 lakh will not meet. Now based on this annual target only, you have taken your NPV decision, you have taken your working capital management decision, you have taken your capital structure decision. All the decisions are based on that number. Now if that number itself is not correct, all the decisions also goes for a toss. So performance management is very important. Which means it is like how, for example, you go to a doctor. Now when you are going to a doctor, you are telling that I am having fever. Now doctor is evaluating, calculating, basically he is taking the BP, this, that, test, urine test, everything is taken, blood test, and afterwards he is telling that you are having this problem, and after doing the problem he is giving you a solution, which means he is giving you some tablets, he is giving you some injections. Now that is done. That is what you will do as a finance manager. A proposal will come to you. You will check the proposal. You will evaluate the proposal. You will apply some techniques, capital budgeting techniques. Based on that techniques, on the decision rule, you will take some decision. And your decision will be, let's say this. Same way, a doctor will also take a decision that I want to give this tablet and this solution. Now, once he has given the solution, the problem does not end. Now, the doctor tells, right, I'm giving you this tablet. After 1 week, come again. I will see what is the performance. Correct? Then, after 1 month, he is coming and then he is checking, fever is still there. Then he will change the tablets. And then he will tell that after 1 week, you come again, I will check. Then after 1 week, he will come again. The fever will be reduced. Then he will again give the tablet. After 1 week, he will come again, and then he will say, you're normal, done, tata, bye bye. Similar thing, that come again, that process is there, right? That process is called as performance management. Are you all understanding this? Now, this process is performance management. Basically, after taking a decision, you have to evaluate your performance. That is what is performance management. So, what is strategic performance management? Performance management that is aligning with my strategic goals of my business. Simple. Okay, or pair strategic quota, it doesn't mean, okay, a word strategic management doesn't mean that the meaning is changing. It means that performance management, and I have to take strategic performance management that aligns with my organization goals. I should not measure performance that doesn't even require. Correct. I am coming for fever. Doctor will not check for cancer and all. Not required. Why should I check these performances and all? Are you understanding this? Okay. Which means, sir, this is performance management basically. Now see the textbook definition. Performance management is a continuous process. Correct? Continuous process. It is a process. Either you have to go to the doctor daily, or you have to go to the doctor weekly or monthly. Okay, it is a continuous process of identifying, measuring and developing. Sir, I have to identify, I have to measure the performance. First I have to identify the performance measure, then I have to measure the performance, and then I have to develop the performance. I also have to improve the performance of individuals and teams. So individual performance, team performance and organization performance, and align the performance with the strategic goals of the organization. Basically, that is what is performance management. So this performance management is from the perspective of individual, teams and organization. So how an individual is performing and whether his performance is aligning with my organization's goals or not. Let us say I am having 20 sales managers and my overall target is that my sales should increase by 20%. Now, if my sales should increase by 20%, each manager should contribute at least 1 in sales. Now only then I have 20 sales managers, and then my overall performance of 20% will achieve. Now let us say 3 managers have not achieved the target 1% also. They have only done 0.2% sales. Now it means that their performance are not aligning with my strategic goals. Now what I have to do? I have to develop their performance. I have to apply some strategies to see, okay, what could be done, what better could be done, where is the problem, why they are not able to sell. Correct. Then I have to identify the problems. See, before identification of problems, measurement of problem is the important thing, because anything that can be measured can be managed. Understanding this? Anything that I can measure, that I can manage. Something which is not measurable, how I can manage? Example, sir, I got less marks, I want to improve. If someone is coming and telling this blunt statement, I got less marks, I have to improve. Now what will happen? What will I tell? I will tell some generic things. You revise, you write this, you did this chapters. Now if he tells me clearly, if he is measuring his performance and is telling me, sir, I got 38 marks in financial management and this is my answer paper where I am not able to attend these 3 questions. Now he is measuring his performance and he is telling me, now I am able to directly identify where is the problem. Then I will see that you are having problem in understanding these 2 chapters. So these 2 chapters alone, you see the videos, it will be okay. And then he will be passing. Are you all understanding this? So anything that can be measured, only if I can measure the performance, I can manage the performance, I can develop the performance, I can improve the performance. If I am not able to measure the performance, I am not able to manage. Let's say we are doing a business. Okay, let's say we are doing a business. Now, when I am doing a business, continuously I have to measure what is my sales, what is my cost, what is my profit. Correct, this is not accounts. At the end of the financial year, then after the financial year is completed, you are sitting and then you are preparing the accounts, P&L and balance sheet. By that time, everything would have been done and dusted. Correct. I always say that accounting is nothing but working on dead numbers. All the numbers are dead. Sales completed, cost completed, salaries paid, everything is done. Now after doing, now you are doing the post-mortem. What has happened? Correct. It's of no use. Okay. Which means accountant is like a doctor who is doing the postmortem, and a financial manager, a CFO, is a person who treats the live person. Now you only tell me, pa, who has more value? That postmortem doctor is only the live doctor. Understanding? A live doctor. Are you all with me? Who will be paid more? A live doctor. So a business which is running is coming to you, and you are assessing the performance in a running business. That is where you are able to give some solutions. From reading the balance sheet and P&L, management will have no value add. That is just a disclosure for the stakeholders. I want to throw these financial statements to my shareholders, to the bankers, to the stakeholders, and I have to show that, hey, this is my balance sheet. Mostly today's world, balance sheet and P&L are prepared for regulatory compliances, nothing more than that. Correct? It is not that much value add for a management. A management will not get some super insights from the financial statements and all. Basically, a manager will just stare the financial statements and throw away. Sir, what he will look at? He will look at your papers. Now, when you're giving them MIS report, now MIS report is what? A continuous report. Every monthly one report, weekly one report. That MIS report he will be seeing, because he will be getting insights out of it, because that numbers are still alive. Are you with me? That are not dead. So that is where performance management will help in. So performance management is a continuous process. That's why I tell continuous process. Accounting, what is accounting? A books is closed, then you will start the accounting process. It is also continuing, but preparation of financial statements will be done only when the books is closed. Books are not closed, preparation of financial statements will not start. So here, there is no closure, nothing. It is a continuous process of identifying, measuring, developing performance of individual teams and aligning the performance with the strategic goals of the organization. And this is the key word: anything that could be measured can be managed. Sir, in layman terms, performance management means right people are doing the right work in the right manner at the right time to achieve the organization strategic performance. Come again. Sir, performance management means the right people are doing the right job in the right manner at the right time to achieve the organization's objectives and goals. That is what is performance management in actual terms. In real terms, that is what is performance management. If a wrong person is working on this job, my performance will affect. A right person is working at a wrong time, my performance will affect. Correct? A right person will working in a wrong manner, my performance will not be efficient. So basically my performance should be efficient so that my output should be optimum or more. So that is what is basically performance management. You can see performance management from the costing perspective also. You can see performance management from the financial management performance also. So in this we will be studying a blend of all these things. I'm giving you an information, an introduction to performance management, so that you will be understanding what is the subject is all about. Sir, what are all the things that you are going to learn? Basically, majorly what you are going to learn are the performance management tools. Sir, traditionally also performance management was being done. Traditionally, people were only focused on financial performance. Everyone were asking just one thing: what is my profit? What is my ROI? What is my ROC? What is my return on assets? What is my return on capital employed? What is my net profit percentage? What is my gross profit percentage? People are only worried about financial measures, financial performance. Correct? But in modern world, in today's competitive world, financial measures are important, but non-financial measures are also important. Now you're seeing the new ratios like ROAS, return on advertising spend. You will see like in the SaaS, okay, wow, how much customers are there, the churn rate of the customers. Correct? Now if you see the malls, how much footfalls in the shops. Footfall means how many people are coming to the shops. Now these are not financial measures. These are non-financial measures, but these are very much helpful in decision making. Are you understanding? So this is modern way. Okay, this is basically modern world. Now in the modern world, people are not worried about, people are not only worried about financial performance, they are also worried about the non-financial performance. Now if you see any tech company, they will see like how much clicks, okay, in my website, click per day or lifetime clicks. Or if you see all the Zomato and app making businesses, so they will tell how much subscriptions or how many active subscribers are there, you know, for their product. Now if you see a business of some gaming, they will tell how many number of hours this game has played. Or if you see some social media application, how much number of hours people are using that applications. Are you all understanding? So if you see any website, they are having some non-financial measures also, and based on that non-financial measures, they will be able to take some decisions about what is that measure, sir. That is performance management. That is performance management. So this subject is also the most practical subject that you will learn today, and then you will be applying afterwards. Okay, sir, but this is performance management. Basically, traditional versus modern. Earlier, organizations were mainly focused on financial performance. They will see what is my profit, they will see what is my ROI. If it is good, they will just sit. But today's terms, in the complex and competitive environment, this is not enough. Only performance or financial performance is not enough. Management focuses on financial and non-financial measures. So I told you, like non-financial measures like footfalls, ad spends, or clicks. Okay, so all these things are very important. Non-financial measures. Short-term and long-term performance. So short-term performance also they will look. Long-term performance also they will look. Short-term, one week performance also they will look. One employee is working for how many hours and how much hours he was efficient. Correct. These things also they will look. In long-term performance also they will look. From 5 years to today, okay, what is the improvement? So these things also they will look. Individual, team and organization performance. Not only we will see the individual performance also. Individual employee how he is performing. Team performance also. Individual teams how they are performing. And organization performance as a whole also they will check. Aligning the employees' efforts with organization's goals. So whatever the employee efforts are being made, we have to shift that efforts to achieve my organization goals. So I will give the targets to the employees in such a manner that it will be aligning my organization's goal. Like the example that I told, if I want to achieve a target of 20% more sales and I am having 20 salesmen in an equal designation, let's say, so which means each salesman should at least achieve 1% sales. Only then cumulatively 20% will achieve 20% sales. So that is the target that I have to give. Now why I am giving this target? To achieve my organization's goal. Now I cannot give a target, okay, 0.5% you achieve, that is enough. No, because that is not aligning with my organization goal. My organization's goal is 20%. So first your organization goal is set. Then that goal is divided to team. Then that team's goal is divided into employees, individual goals. So what are the modern performance management techniques? So this is just an exhaustive list, not a full list. Lot of more techniques are there. I'm just naming a few. Balanced scorecard. So balanced scorecard is a scorecard of the company. I'm just giving you an introduction. So that will give you the performance measure also. So balanced scorecard means 4 measures it will measure. Financial measure also it will do. Non-financial measures like employee measures, okay, the learnings and growths and opportunity measures. So these measures and all they will calculate balance. Then total quality management. This only talks about the quality. Okay, so total quality management, total productivity management, okay, so TPM, TQM, these are all the concepts of performance management tools. Six Sigma, that talks about perfection, okay, Six Sigma talks about the perfection, how perfect I am. So this measure is being done in Six Sigma. Key performance indicators. Every employee, every team will have some KPI that they have to follow. For example, a CFO will have a KPI like my EBITDA should increase by 10%. Correct. A salesperson will have a KPI that I should make at least 20 sales. Correct. For example, a customer management will have a KPI. For example, I have to onboard at least 3 new customers every month. So these are all the key performance indicators. Now I cannot give this one person's KPI to that person. Every person's KPI will be different. An analyst level KPI will be different, manager level KPI will be different, CFO level KPI will be different, and every person should achieve their KPI, and their KPI is set in such a way that is aligning with the organization's goal. Are you all with me? Okay. Sir, benchmarking. So we will set some benchmarks. So based on these benchmarks, we have to work and we have to see what is the gaps. Economic value added. What is the economic value added that we are making? Management information system, MIS. So MIS is a continuous reports that the management will prepare, seeing all the performances. financial measures also, non-financial measures also, every week, every month. So based on the size of the company, and based on this, so basically this is nothing but everything they will see every month or every week. So this is also MIS. And then customer profitability analysis. Okay, so profitability analysis, you know, sir, my total profit is 100, but out of these 100 people, let's say I'm having only 3 customers, so then I will see what is the customer level profitability analysis, and that too in depth I will see. And in depth I will see the customer profitability analysis, and from there I will analyze that which customer is giving me more profit, which customer is not giving me more profit. Let's say I'm having 3 customers, A, B and C. A is giving me 50%, 50 profits, B is giving me 60 profits, C is giving me 10 loss. My overall business will say 100 rupees profit, but if I don't give to C, my profit will increase from 110 rupees. So this is customer profitability analysis. Customer wise or segment wise, I will see what is my profitability. Okay, some customer segment will be profitable. For example, a business which is doing in all the regions, south region, north region, west region. Now in the west region, they will not make much profit. North region, they will mint profit. South region, you are getting average profit. Correct. So overall profit is again analyzed into either customer segments or geographical segments. Okay, so based on different segments, we have to do some analysis. So that will give you some insights. On and all, what you are going to study in this subject is all measurement tools. Lot of measurement tools are there. Based on these measurement tools, how you can take improved business decisions. That is what you're going to study in this subject of strategic performance management. Then again, business valuation, that's a separate ball game altogether, where you're going to value the business. Now where it will be helpful? It will be helpful in the stock market thing. It will be helpful, it will be helpful when someone is going to, purchase some other company. And then we will be studying practical case scenarios of M&A. For example, I will be practically telling you, okay, what are the mergers and acquisitions, what are the mergers and acquisition transaction that is being done, okay, what is the conversion ratio, all these things we are going to discuss practically from the internet. We are going to study all these things, practical approach we are going to study, so that any question that comes into the question paper, you will be easily able to handle. That is what is my objective. Okay, now, sir, these are all the things that you have told to us. Okay, these are all the things that you have told to us. How many hours, sir, it will take? See, on an average, it will take 80 to 100 hours. In 80 to 100 hours, I will try to complete both the strategic performance management and business valuation. Okay, and in a very comprehensive manner, you will also get a concept note. Based on that, okay, you can take in the examination, and then you can write all the answers. That will be very much helpful for you. And these are some of the things that I wanted to discuss in the overview. Okay, in the overview lecture. See, today I will not give you so much of dosage of concepts, number, calculation, problems and all. Okay, I just want to tell you that what is the value addition that we are going to make in the classroom discussions. Okay, and talking about this M&A, I am a financial consultant for a company where M&A transaction has happened, and I was mainly appointed for the M&A due diligence things. So practically I will tell you that what are all the things that will happen in M&A, how things are being valued, okay, how business takeover, how people will find their target companies. All these things we are going to study in business valuation. Okay, even in performance management valuation, we are going to study a lot of things, we are going to study. So basically, in my profession, this is what I do. I am a finance manager, I'm a virtual CFO of a few startups, and I'm a practicing chartered accountant. For those who don't know me, my introduction is that I'm CA Thofik Tufel. I'm from Chennai, and I'm teaching from past 2.5 years for CA and CMA inter and final levels, financial management and the elective papers that covers the finance part. And I am a practicing chartered accountant. I am a partner of a firm that are having 10 partners and 12 branches, 3 branches overseas, and I manage the the south office of that business, the CA business, where my major focus is only on finance. So basically, I don't do much compliances and all. I do majorly finance. I don't do much tax audits, ITRs. I do majorly finance. So that's the reason the understanding and the insights that you will get from a person who is practically been in that field will be much more better, and the difference that you will feel after the class. I always tell to my class that my objective is to nudge your mind so that you will be curious, you will be asking questions to me, and then I will be giving the solutions to that questions, and in this process you will become mature, and that maturity will be very much helpful not only for the examination but also after the examination. Are you all with me? Okay, so see you on the other side of the class. We are going to discuss a lot, and see you soon. Register soon. We will be starting the classes. You will be getting the books, and everything will be taken care of. You will be having some test series also. You can come here, you can take the use of our study hall. So we have recently launched a study hall also, where you can just come and you will get a peaceful environment. You can study, and chartered accountants will be sitting there to mentor you. So proper personal guidance and mentorship is also being done and being taken care of. So everything we are providing you, basically our objective is to create an infrastructure, so create an environment where it is fully compatible for you to clear your examination. So that is what is your objective. Okay, so I hope that was a great introduction for you all. Thank you very much. See you on the other side. This was CA Thofik Tufel signing off for now. Bye. Now, let us also get into the introduction to business valuation. So as you are aware, our subject is not performance management alone. Performance management is one part which is independent, and business valuation is one part. So our subject is known as SP, M and BV. So our subject is SPM and BV. So this is strategic performance management, and this one is business valuation. This is having a weightage of 50%, and this is having a weightage of 50%, as we have already discussed here. Okay, so sir, section B is business valuation, that again covers 50 marks. Now it has 5 units, 5 modules again. Fundamentals of business valuation, that talks all the basics of business valuation. What is business valuation? Why business valuation? What are the approaches of business valuation, and when we have to use? All the types are discussed. The second one is laws and compliance of business valuation. So which law talks about business valuation and why we have to do all these things. And the third, fourth and fifth are the core of business valuation. One is methods and approaches. How many methods are there and how to approach? So numerical thing. Valuation of asset and liability, how to value our assets and liabilities, and valuations in mergers and acquisitions. So in mergers and acquisition transactions, how to value. So these are the 3 topics which are there in business valuation. So our objective now is to have an overall view of how this subject will look like, what are all the things that you have to study in the subject, and some explanation about business valuation, so that you all will be aware of what you are going to see in this subject. Now, sir, this business valuation, it has 2 words, right? Business and valuation. You know what is a business, correct? See, in simple terms, a business means someone has invested with an expectation of some return from that investment. So basically this process, this part is called as business. In business you have 2 components. One is investment, and the second one, you will do the business, and end of the day you will get some return. So that is what is the business is all about. So the process with which you are using the investment to get the return is business. Sir, valuation. Now I will just tell you a small example. Whenever you do some business, what is the goal of any business? You have studied at inter level also. Okay, what is the goal of any business? Correct? Or whenever we talk about business, what is the goal? If I'm doing a business, what is my ultimate objective? See, it is twofold. The first one is I want to increase my profit. Correct? This is one objective, or this is the reason. This is why you're doing the business. One is I have to increase my profit, and the second one is I have to increase my value. This is something that we studied at CA inter level also, or CMA inter level also, when we talk about importance, or when we talk about the objectives of financial management. Sir, what is the objective of financial management? It is twofold. Correct? Profit maximization, wealth maximization. You all can remember these things. Correct? So we are doing business. One is I have to increase my profit, and the second one is I have to increase my value. Now when I talk about value, okay, when I talk about value, what is the value? Correct? When we talk about value, how you will see that whether my value is increased or not, or what is value, how value is calculated, how you have to interpret this word value. This is what you are going to see in this entire section of business valuation. Sir, which means when we see here in business valuation, what is the goal of any business? The goal of any business is to increase the value. The goal of any business is to increase the value. Now the question is, what is value? Now this is the $1 million question that we have to ask. Sir, why are you telling like this $1 million question? Again, you take it from me. A person who knows how to value business properly can be the richest person. Now, why Warren Buffett is rich? Correct? Or if you see a lot of big investors, basically they became rich just because they know what is the value. If you are able to properly evaluate or calculate the value, then based on that value, if you're investing, definitely you are going to become rich. So this is the money subject. Correct? I always tell financial management, or when we talk about this valuation is a part of finance. So when we talk about valuation, these are all the money subjects. Okay, sir. So what is the goal of any business? To increase the value. Sir, what is value? Is the next thing. Okay, it is the next thing that we are going to discuss. Let me just take an example. Okay, let me just take an example. Let's say, okay, currently now I am in Anna Nagar. Now here I am in Anna Nagar. Opposite I am seeing a building. Okay. Opposite I am seeing a building. Say, don't worry, pa. My handwriting is bad. My diagram is worst. So opposite I am seeing a building. Now I want to purchase this building. Okay, I want to purchase this building. So there is an owner of this building. Now this is TT. It's me. Now I want to purchase this building. Now what's happening? I am going to the owner and then I'm asking, I want to purchase this building. Now how you will ask? What is the value of the building? Correct? This is what you will ask. What is the value of the building? Based on the value only you are going to invest. Now this person owner, he cannot tell a random figure per 100 crores. It should match with the value. Correct? Probably 100 crores is the price that he is quoting. It doesn't mean that I am going to pay 100 crores, or it doesn't mean that 100 crores is the value. Are you understanding? If I am paying 100 crores and buying this building, I am a fool without understanding the value. So if you understand what is the value, only then you will be able to make proper investment. Otherwise you will be at a loss. I'm just giving you an importance why we have to value. Now this is in terms of real estate. Now valuation is there in everywhere. When you're purchasing a building, you have to know what is the value. When you're purchasing a share, you have to know what is the value. When you're purchasing a business using mergers and acquisition, you should know what is the value. When you're purchasing any kind of assets, machineries, you should know what is the value. Correct? So based on the value only you're going to purchase. Without knowing the value, if you're purchasing, you will be at a loss. Without knowing the value, you should not purchase anything. So valuation becomes a vital role in any business or in finance. Okay, sir. Now, when you're talking about value, sir, how should we value the building? Is an extra discussion. No, we have certain valuation approaches. Okay, we have certain valuation approaches. So let's talk about, we have three valuation approaches. The first one is market approach. The second one is income approach. And the third one is cost approach. Okay, these are the three valuation approaches. Okay, now based on these valuation approaches, you will calculate what is the value of the building. Let us say that you are calculating the value of the building is 80 crore rupees. Now you all tell me, will you pay 100 crores? No. Or if the price is 100 crores, because if he's quoting means this is the price. Now if the price is 100 crores and if the value is 80 crores, is it overpriced or is it underpriced? There is a concept, right? Sir, my value is 80 crores. My price is 100 crores. It means that the building is overpriced. Overpriced means than value. Value is always kept as a benchmark and price will be moving. Correct. So now if I say that today the value is 80 crores and one person is telling that I am going to sell this building for 100 crores, it means it is overpriced. I am not going to purchase that. Because the value itself is 80 crores, why will I pay 20 crores more? The value considers everything. You cannot sell premium, everything considering only value is 80 crores. Now if the value is 80 crores, I will not pay even 1 rupee more than the value. Correct? Because value is what I am getting. Now if I am getting 80 crores worth of building for 100 crores, it means today itself I am making a 20 crore loss. I hope you all are understanding this point. Okay. Suppose the value is 120 crores. I calculated, okay, and the value, some registered valuer is there. Now there are valuer, okay, or registered valuer. It is a very, important course. Engineers will be the registered valuers for the building. Okay, so registered valuer is giving the report that the valuation of the building is 120 crores. Now the person is ready to sell the building at 100 crores. It means that I am making a profit today itself, because today the value of the building is 120 crores. So which means value means what? Today, if at all, okay, probably why he is selling at 100 crores, he want money today. Correct. Otherwise, you have to, talk to a lot of brokers, real estate brokers, talk to a lot of real estate brokers, and then he have to, a lot of time will go. Today, there is some urgent, he is in a financial crunch situation. He want to dispose of his building. So that is the reason he is saying, hey, you give me 100 crores, I am ready to give this building to you. Now, what I will do, I will see what is the value of the building. Now, I am seeing the value of the building is 120 crores. And I am getting this at 100 crores. Now tell me, is it overpriced or is it underpriced? Value is 120 crores, price is 100 crores, it means it is underpriced. Now because it is undervalued, okay, because it is undervalued or underpriced, what I am going to do, I am going to purchase that building. Correct. So buy or sell decisions are taken using valuation. If you know the value, you will be able to take a buy or sell decision. Whenever someone is asking, right, hey, I want to purchase, I want to know whether I should buy Reliance share or whether I should sell Reliance share. Okay, he is having some shares in his portfolio. Now he is asking you, a person is coming here and asking, hey, I am having 1000 Reliance shares. I am having 1000 Reliance shares. Should I buy more or should I sell? Is the question. Now how will you answer this? Will you toss the coin now? Hey, buy, hey, sell? No. First, what you will do, you will see what is the value. Now, what is the value of Reliance? Now you are seeing that the value of Reliance, based on your valuation methodology, your value of Reliance is 2500 rupees. Now this is what is the value that is you are estimating based on your judgments. And now you are seeing what is the price of Reliance. You are seeing the price of Reliance is 2000 rupees. Hey, the price is 2000 rupees, but the value is 2500 rupees, which means that the share of Reliance is underpriced. It is undervalued. So what you are going to do? You are going to buy this Reliance. Okay, you are going to buy. Why? Because it is undervalued. Now anything which is undervalued, you will buy. Sir, why you are buying, sir? Because price is 2000, value is 2500. somewhere later this value will unlock, right? Some news will come, okay, or something, it will unlock, people will know, a lot of people are seeing, so they will build, they will buy, and then slowly price will increase. So anyhow it is going to reach 2500 as per my judgment, correct? So it is undervalued and I am going to buy the shares. Now everything, all the transactions are dependent on the value, okay, on the value. If you are calculating the value correctly, you're going to make a lot of money. But if you're calculating the value wrongly, let us say that you did some mistake, actually the value is 1000 rupees only, you did some mistake and you told that value is 2500 rupees, actually the price is overvalued, but what you're doing, you're purchasing. Now what will happen? It will be a loss. Why? Because currently the price is 2000, tomorrow it will fall down to 1000 rupees and you will make a loss. So valuation is a $1 million concept that you should be knowing. If you know this concept of valuation, okay, any transaction you will be able to take the decisions properly. I'm telling you why valuation is important, why you have to value. So why you have to value before taking any transaction, knowing the value is very important. Second one, any deal is happening, mergers and acquisition deal is happening. Today Reliance is, if you see the, mergers and acquisitions, so just today when I'm recording, that is 30th of June, this demo lecture, from today, I'm telling you practically, from today, Geo Financial Services, okay, this is one more division of financial, so Geo Financial Services, it is a division of Geo. So Geo has started its mutual fund business just today. Today I read the news, Geo has started its mutual fund business and 3 mutual fund offer, okay, 3 mutual fund offer today itself they released. So I think 7th or 8th July is the last day to apply for this, for share we call it IPO, but for mutual fund we call it this initial fund. So if you see, today 3 funds they have started, Geo Financial Services, and the best part is they are not doing it alone. They are partnered with BlackRock. Now BlackRock is a very big financial institution in the world. People tell that BlackRock actually controls the world economy. That much big this BlackRock companies. So they partnered with Geo in India and they started a mutual fund business. Very recently only they got a mutual fund license, and today itself they released 3 mutual funds. Now if you see, this BlackRock has been a joint venture or partnered with Geo Financial Services. Now this is an M&A deal, mergers and acquisitions. Now this is a merger. BlackRock has been merged with Geo Financial Services, not the entire company, the Indian division itself, and they wanted to start the business in India. So they partnered with Reliance or Geo, and then they started a mutual fund business. Now sir, what's the big deal in here? Okay, what's the big deal in here? If you see here, why BlackRock partnered with Geo Financials? There are other companies also. We have Aditya Birla Finance, we have Shriram Finance, correct? We have a lot of finance, we have HDFC Finance, okay? We have a lot of finance companies, Cholamandalam Finance. See, because they saw some value in Geo. That's the reason. Or Geo has saw some value in BlackRock. Because BlackRock is not a small company. You can just Google or you can just chat GPT about BlackRock. You will get to know that it is not a small company. Actually, Reliance is nothing in front of BlackRock in terms of size of the company. So that much big, company is this, and they have just started their business today. So this is one example of merger and acquisition. Sir, M&A is one very important domain in finance, and in M&A valuation have a pivotal role, because without valuation no M&A transactions can be done. Because any M&A transaction, one person is having a value, another person will pay a price. Let us say company A wants to acquire company B. If company A wants to acquire company B, they have to pay something to company B, right? Just like that in free, they cannot acquire the company. Now how you will pay? Either you will pay by cash or you will pay by shares. I will pay you the shares of A Limited, something that you learnt in accounts, correct, amalgamation and all these things. Now, if at all I want to pay B, how much I have to pay? And let's say that I am paying 100 crores. Now this 100 crores is determined using valuation. So I'm just giving you some thing where valuation is used. So I told you, in any share transaction that you're doing, any financial instrument transaction that you're doing, any real estate transaction that you're doing, in M&A, in all these places, okay, all these places, valuation is used. Correct valuation will be the correct, judgment. Valuation is a factor of judgment. There is no one number. If I tell that Reliance value is 2000, one more person will come and say that no, according to me Reliance is 3000. Sir, now which value is correct, sir, 2000 or 3000? There is no right or wrong in valuation. That's where the tricky point comes in. There is no right or wrong value, because value talks about the future benefits. Value talks about the future number. Today, no one will know, correct, what is the correct value. Are you understanding? So you guys will not know, correct? If you know that one company is going to definitely perform well in the next 1 year, everyone will be betting there only, right? No one knows. That's the tricky part. Now, if one person A is telling that the value of Reliance is 2000, person B is telling that the value of Reliance is 3000. So if the value of Reliance is 3000, he will be heavily investing. If the value of Reliance is 2000, he will be less investing. Now, how much he has to invest is dependent on how much he is expecting the value. Now, he is expecting, super, the value will be 3000. Currently, the price is 1000. Price is also very important. So, currently, the price is 1000, and tomorrow tomorrow means 1 year or 2 years value, it will become 3000. It means that I am going to invest. I am going to sell my house for 1 crore. I am going to invest here 1 crore. Correct. After 2 years, this will become 3 crores. No real estate will give me this return if I am able to estimate the value correctly. Let's say this person B has not determined the value correctly. After 2 years, this 1000 is only 1100. Now he will be at a loss. Correct? Because had he kept it somewhere else, it would have been increased. Correct? Now it has just increased 10% return in 2 years, which means 5% per annum. Had he kept in FD, he would have gotten 14-15% in 2 years. Are you guys understanding this point? Correct. So valuation is very important. So why are you telling all these things? See, if you read the study material now, everything will make sense. Let's see fundamentals of business valuation. Okay. The ultimate purpose of any business is to create value. Okay, is to create value. Value creation is the key. Now that is where the subject itself starts. So that's the 0 point, the starting point of the subject. Any business will do their objective is to create some value. Now how to calculate this value, how to interpret this value, that's where everything starts. Okay, that's where everything starts. Now very important, valuation requires both judgmental and interpretation of data. One judgment is also required. Judgment means, correct, already I told you, right, if you saw the my demo video of strategic financial management, I've talked about Ashwath Damodaran, the valuation guru. Now he is extremely intelligent and he is having a valuation approach that he will usually value the securities with a reasonable level of accuracy. Reasonable level of accuracy. See, no one can tell that he is 100% accurate, which means he is God. Okay, so no God here. Reasonable level of accuracy. Let's say that I am estimating the value and my accuracy is 80%. And one more person is estimating the value and his accuracy is 50%. So which means people will believe him, because 10 out of 8 times he is wrong, but 2 times he is wrong. Sorry, 10 out of 8 times he is correct, but 2 times he is wrong also. Who knows that the next thing he is telling will be wrong? Correct. So no one knows that, but everyone will see that past history and this. So based on that, valuation guru Ashwath Damodaran, okay, he is very well known for valuation. You can read his book also, and you can see the YouTube channel of Ashwath Damodaran. Free lectures he will put, okay, not CMA and CA and all. He teaches for US, okay, he's a US based person and he teaches for some US degree, okay, Masters of Finance and something. So there, okay, he teaches valuation, extremely advanced level of valuation, but the level of understanding that he is having is great. Now, why I am telling his name is that I've even told you the Zomato example also. Okay, in the past video you saw, I've even show you the Zomato example. Now I'm telling you one more example. Okay, now I'm telling you one more example. Let us say in one place Ashwath Damodaran is telling that the Reliance will go to 2000 rupees. And I am telling that, okay, I am telling that Reliance will not go to 2000 and all. Reliance will actually fall down at 1500 rupees. Correct. And the current market price is 1750. So Ashwath Damodaran is telling value is 2000 buy. I am telling value is 1500 sell. Let's just take an example. Now I am a new person. He is having 20-30 years of experience, let's say. Now I am a new person, just having 5 years of experience. Now, whether you will buy or you will sell, you will believe whom? Ashwath Damodaran, you will believe Thofik. Okay, everyone is telling Ashwath Damodaran. So you will believe Ashwath Damodaran and you are going to buy the shares. Fortunately or unfortunately, the share price fell and it came to 1500 rupees and you made a loss of 250 rupees. Correct, you made a loss of 250 rupees. I sold my shares. So now I made a profit. Let's say it is short sale, or let's say that I saved with the 250 rupees. So savings is also my profit. So now, which means am I better than Ashwath Damodaran? No. Correct. Because the point that I want to tell here is that valuation is completely based on judgments and very importantly interpretation of data. Now how I am getting this number of 1500? I will be having some data. Based on the data, I will be using some assumptions. Now assumptions are judgments. I will be having some data. Let us say that I am having past 10 years data. And then I am estimating that now it will grow to 10%. And he would have estimated that it would have been growing by 15%. Now based on his assumption, it is 15%. He is telling the value is 2000. Based on my assumption, it will grow at 10%. And then I am telling the value is 1500. Both are based on assumption. And assumption is judgments. My judgment is 10%. His judgment is 15%. And based on the judgment, we have interpreted the data. And based on the interpretation of data, I have calculated some value. So valuation, very important, okay, very important. Valuation requires both judgment and also interpretation of data. Both judgment and also interpretation of data. I hope we are all in the same page now. Interpretation of data is also very important. Judgment you will get through experience. Correct. You cannot tell that, okay, sir, I want to learn how to judge. You cannot. Correct, you cannot. A person who is seeing daily the share price will be having more experience and he will be able to make good judgments. A person is just seeing the share price will not be able to make good judgments. So judgments come by experience. Interpretation of data, that is a skill. Now this is experience and interpretation of data is a skill. So that's what you're going to learn here. Interpretation of data for business valuation. I hope I am filling the buckets of your head with the knowledge that you require. Are you all with me? Hello. See, if you're liking this video, I want you to pause and like this video and put a comment how you are able to, how you are able to interpret this class, or whether you're liking the class or not, and what are your comments on this class. And if you have any specification that you want me to do, I will be incorporating in the next sessions also. And you will be getting a workbook where you will be solving all the problems, all the classroom problems you will be solving in the workbook. That also we are going to provide you. Okay, now different parties can have different interpretations. Okay, different parties can have different interpretations. Again, Ashwat Damodaran can have a different interpretation and I can have a different. So it is an activity. So business valuation is an activity conducted towards rendering an estimated opinion. I have to estimate the value, I have to give an opinion buy or sell to the fair market value of the business interest at a given point in time. So basically this is what is business valuation. Okay, it is an activity that is conducted towards rendering an estimated opinion. Estimate means either I will tell what is the value, opinion means I will tell whether to buy or sell as to the fair market value. Okay, this is the fair price purchase, this is the fair price sell and of a business interest at a given point in time. So why at a given point in time? Today I am telling this is the value. After two months the value will change. After 5 months the value will change. Why? Because the business fundamental also changes, right? The numbers also changes. The value will also change. My assumption will also change. So always value is at a given point in time. It is not that the value of the share is 1,500 now. For a lifetime it is 1,500 only. It will be different. Okay, at a given point in time. Appa sir, these are all the things, and always these things you have to understand. Now one very important statement I'm going to tell you. Price is what you pay and value is what you get. Price is what you pay and value is what you get. This is something that Warren Buffett has told. Price is what you pay and value is what you get. Sir, we have two numbers here, or no numbers, words. One is price and one is value. What you are paying is the price. Suppose a transaction has been finalized. You are telling that 1,500 rupees is the price that I'm going to pay for this share. So this is the price, is what you pay. Value is what you get. You have estimated the value is 2,000. So you are getting 2,000 worth of share at 1,500 rupees. You have to understand this. Price is what you pay and value is what you get. It means that price and value can be different. People will be having a thinking, sir, what is the value? That only will be the price now. Sometimes it will be same, sometimes it will be different. The point that I'm trying to tell is it could be different also. Okay, it could be different also. Say you see the building example. Okay, if you see the building example, 100 crores is quoting. It doesn't mean that I'm going to pay 100 crores. The value could be 120 crores also. The value could be 80 crores also. But the price is 100 crores. Correct. Price means what? The price tag. He is telling I want to sell at 100 crores. The price tag is 100 crores. But the value could be 80 also. The value could be 120 also. Okay. Based on that, we are going to see it is undervalued or overvalued. Okay, sir. Now, I'm just giving you overview for the valuation approaches. The first is market approach. The second is income approach. And the third is cost approach. Sir, what is market approach? Basically, I'm just giving you small overview of the valuation approach. Market approach means you will estimate the value based on market relevant information. Using the market, you will tell what is the value. Okay, few assets will be using valuation approaches, at few places we will be using income approaches, and few places we will be using cost approaches. Now listen to me very properly. Let me take an example of market approach. The same building approach I'm going to tell you that it is price is 100 crores. Now I want to find out the value. Sir, how will you find out the value? Okay, $1 million thing. Okay, how will you find out the value? Sir, how you are telling the value is 120 crores or 80 crores, sir? How you are telling, sir? Market approach. Now see, what is a market approach means? What I'm going to see, I'm going to see the market value of that building. Sir, I don't know. If I know, that is a value. If I know why that person will be quoting it at 100 crores, he will be quoting it at market value only now. If the market value is 120 crores, he will be quoting at 120 crores. If the market value is 80 crores, he will be quoting at 80 crores. Are you understanding? See, if in the chips, the price MRP itself is 5 rupees and the market price is also 5 rupees, it means that no one is going to purchase the lace packet at 6 rupees because the market price itself is 5 rupees. Correct? You see some items, loose items, unbranded items and all, the price will be very more. You know, some shampoos. Just yesterday my mother purchased a shampoo and the price it was written in the shampoo was 1,100 rupees. I was shocked when my heart came out. This is 1,100 rupees shampoo you're using. But then In Amazon, the 1100 rupees shampoo is sold at 500 rupees. It is sold at 500 rupees. Just that it is printed 1100 rupees. Now you see here, the price is 1500 rupees or 1100 rupees, but the value is 500 rupees. Why? Because everywhere it is sold. So that is what is market approach. One example. So I am not going to pay more than 500 rupees. Even though it is printed 1500 rupees in the face, I am not going to pay more than 500 rupees. Because in the marketplace, Amazon, Flipkart, Meesho, in the marketplace, that shampoo is sold for 500 rupees. So I'm not going to pay more than 500 rupees. This is one example of market approach. Now let's say second example. Sir, Anna Nagar, that building, sir, you don't know what is the market value, correct? Because buildings are not sold in Amazon, Flipkart and all, correct? Or not in OLX and all. What you're going to do here is that this building, pakadale you have one more building pa. Now this building is having 10 floors, for example. Pakadale you are having one more building of 5 floors. Just yesterday a transaction happened and this 5 crore building was sold for 40 crores. This 5 crore building, sorry, this 5 floor building was sold for 40 crores. Okay, just very recently this transaction happened. Very recently this transaction happened. Now based on that I can estimate the market value. If that building of 5 floor has been sold in the market for 40 crores. Now sold means what? One person is ready to sell, another person is ready to buy, which means that is the market price, 40 crores. Now 40 crores is for a 5 floor building, which means for a 10 floor building it is double, 40 into 2, 80. So which means my market value is 80 crores I am estimating. This is one way. A common sense approach. This is what is market approach. So we have 3 approaches: market approach, income approach, and then cost approach. So these are the 3 approaches. So now we have discussed market approach. So market approach means I will indicate the value by comparing the asset with identical or comparable asset. Like I told you the example, if I want to find out the value of a building in Anna Nagar, I will see the value of that building in the same street, correct? And then based on that I am going to estimate the value, for which the price information is available, because the information is available, right, that the 4 floor building or the 5 floor building was sold for 40 crore rupees. So the same information I will be having. So this is called as a relative valuation approach. This is called as relative valuation approach. Now this is one method. Okay, this is one method. Okay, comparable companies multiple method, market price method, comparable transaction method. So the example that I told you was comparable transaction method. Okay, let us come to the second one, which is income approach. Now when we talk about the second one, income approach, we will be valuing the asset based on how much income that it is generating. Let us say I am having 2 buildings, building A and building B. Correct? Building A and building B. Same street, okay, same street. Both are connected. Both are connected. Both are joint connected. Building A and building B. But both are 2 separate buildings in the same street. Now here, I don't know why, but here I am getting a rent of 2 lakh per annum, and here I am getting a rent of 2.2 lakh per annum. Probably some vastu, I don't know why people are ready to pay more rent. Both are same building, identical twins, but this I am getting a rent of 2 lakh per annum. 2 lakh every year I will get a rent, and here I will get a rent of 2.2 lakh per annum. Now which building will have more value, building A or building B? Building B will be having more value because it is generating more income. Are you understanding this point? Because it is generating more income. So that is the reason building B will be having more value. So this is called as income approach. I am going to say which income or which asset is generating more income. Based on the income generation capacity, I am going to value. So how to calculate the value? Value is nothing but present value of future cash flows. So here all the future cash flows I will estimate, and then I will do the present value. Here all the future cash flows I will estimate, and then I will calculate the present value. Definitely the present value will be more. Why? Because the cash flows are more. Correct. So this is called as income approach. And then the third one, which is called as expense approach. Okay, third one, which is, so this we done right, discounted cash flow method. And the third one is called as expense or cost approach, not expense approach, it is cost approach. So market approach, income approach, and cost approach. Now in the cost approach, if, sir, when I have to use cost approach, where I cannot use market approach, actually market approach is the most primary approach. First you have to check, can you use market approach or not? If no market information is available, only then you will be using income approach. And if income approach is also you are not able to use, then you have to use the cost approach. Then you have to use cost approach to value. Sir, what is cost approach, sir? Sir, how can you tell that income approach, market? Now let's say that I am having a machinery. I am having a machinery. Now it's a specialized machinery where there is no market price available. I have actually discovered this machinery. You itself tell that I have already discovered this machinery, invented. I have invented or I have innovated this machinery which is having some specialized used. So there is no market value information available. So market approach I cannot use. Till now, the applications of the machine is unknown to me. The application of this machine is unknown to me. So I cannot even estimate how much will be the income which is generated from this asset. So income approach also I cannot use. But someone has to purchase this machine. Now I want to sell this machine. Sir, no market value available. Currently it is not generating any income also. Based on how you use, you will generate the income. Now, then you have to use cost approach. Now cost approach means what? How much cost you have spent to invent this machine, because you should know some ballpark number, right? Sir, I have spent around 5 crores, sir. So less than 5 crores you cannot sell, because the cost itself is 5 crores, correct? So less than 5 crores you will not sell. So the value is anyhow more than 5 crores. 5 crore or more is the value. Sir, how you will do this is called, you have a method called as, in cost you have a method called as replacement cost approach. What is replacement cost approach? If I replace the machine today, what would be the cost? So that cost is the value of that machinery. For example, I'm having a value. I'm having a machine, a running industrial machine. I purchased 5 years back for 5 crore rupees. Now 5 years gone. Today I want to sell this machine. Sir, what is the value of this machine? Now you will tell, today if I want to replace the machine, how much it will cost? So today if someone wants to purchase this machine, so a 5-year-old machine, what is the replacement cost? So that is the value of this machine. That is one. Second one, we also have a method which is called as, one is replacement cost method, which means today if I want to replace what? And the second one is duplicate. If at all I want to create the same machinery today, how much it will cost to me? So that is also the value of this asset. Sir, today if I want to assemble this machine, so it is costing me this. So that is what is the value. So this is called as cost approach. See, basically cost approach is the least used method. Only when market approach is not available, income approach is not available, only then cost approach is used. That reflects how much amount would be required to currently replace the service capacity of an asset. It is also called as current replacement cost. Okay, these are some of the examples of replacement cost method. Now, which of the following methods involves the conversion of future cash flow into single current value? Future cash flow, single current value, it means what? Income approach. Understanding, you see the first one is C, income approach. Sir, which valuation approach should be applied when the asset has not yet begun generating income but it is projected to do so? So not yet generating income, so income approach I cannot use. Market approach, there is nothing available. So which means it is, cost approach. Okay, it is cost approach. P, cost approach. It is, sorry. Projected to generate income. Projected to generate income means you can do income approach. I missed this point. Projected to generate income. If it is projected to generate income, which means what? You can use income approach. Why? Because tomorrow's income you know. If tomorrow's income itself you don't know, only then you will apply cost approach. What is the NPV based on in the discounted cash flow? Now, what is the NPV based on in the discounted cash flow method? Future cash flows, past cash flows, current market value. Actually, NPV means what? The future cash flows discounted at present value minus discounted cash outflow. That is what is future cash flows. So third one is A, future cash flows. It is based on future cash flows. Based on the future cash flow only, you will calculate what is the NPV. What is the net present value? The present value of all the future cash flows is the present value minus investment is net present value. Okay. So which of the following valuation method involves valuation based on valuation multiples of a comparable asset that are traded in the active market? So here it means comparable companies multiple method. This is comparable companies multiple method, which means what, sir? Let me again give you one more example. There is a listed company. Let us say Tata. It is having an EPS of 100 rupees per share and the market price is 2000 rupees and the market price is 2000 rupees. Now we have one unlisted company, okay, one normal unlisted company. This is Tata Motors, okay, and we have one more unlisted company, TT Motors. We have unlisted company TT Motors, so which is having a small size. I'm having an EPS of 2 rupees per share. 2 rupees per share is my EPS because I am not that big. Now what I will do, and what is the market price? There is no market price because it is unlisted company. Now I want to sell my share to some investor. What should be the value that I have to quote? So now again I will again use a market approach, relative value, relative method, comparable, relative comparable method. Now it is a motor company. So what is a comparable company? Tata Motors. Sir, how you are comparing yourself to a Tata Motor company? But just wait. It is a motor company. This is also a motor company. Now I will calculate what is a P ratio. You know what is a P ratio? Price earning ratio. Correct? P ratio is equal to MPS divided by EPS. Price earning ratio. MPS divided by EPS. So my market price per share is 2000. My EPS is 100 rupees, which means my P is 20 times. It is also called as 20x, 20x, or it is also called as 20 times, which means an investor of Tata Motors is ready to pay 20 times the earnings as price. So if 1 rupee is the earnings, I am ready to pay 20 rupees as the price. So if 20 rupees is the earnings, I am ready to pay 400 rupees as the price. My earnings is 100 rupees, so that's the reason I am ready to pay 2000 rupees. So for a Tata Motor company, if they are ready to pay 20x now, assuming that for me also risk appetite is same, so for me also they will be ready to pay 20x. So what is my market price? 20 into 2, 40 rupees is my market price. This is valuation. Are you understanding? Now what I did, this is nothing but again comparative only. Again, like the 5 flows, 10 flows, the same thing only I did, but from a company's perspective. Okay, from the company's perspective. So this is what is valuation. Okay, it is called as P valuation. This method that I wrote, this is called as P valuation. Likewise, you have something called as EV EBITDA valuation. These are all market value. These are all times. P times valuation, EV EBITDA times valuation. Correct? Likewise, you have to do, and based on that, you will calculate the value. So this thing is comparable companies multiple method, because comparable asset trading in the active market. Now fifth one, identify the incorrect statement in the context of valuation approaches. The cost approach reflects the amount that would be required currently to replace the service capacity. Actually, this is correct. Income approach should be applied when the asset has not started generating income yet and cannot reasonably be projected. See, cannot reasonably be projected means if it is projected only, I can use income approach. Correct? Because it is projected, so that's the reason I'm using. If it is not projected, cannot be projected, which means income approach I cannot use. So actually this is incorrect, the answer is B. This is incorrect, the answer is B. So basically now you all know some valuation. What is valuation? Why we are using valuation? What is the importance of valuation? How many types of valuation is there? How many methods of valuation is there? And how we have to value? And these are all the basic principles of valuation. The important part you should be knowing is that this is a money subject. If you know how to value correctly, you will be able to take decisions properly. Okay, so this was for the demo class. We will be continuing our class. Okay, SPMBV, a very interesting area, and we will be continuing the class. So there okay, from that number, or you just go to the YouTube channel, you search, you'll get the number, you can call them, you'll get the detailed revision, detailed schedule, and from there, okay, from there we are going to start the classes. So wish you all the very best. Join the classes. See you on the other side of the class. I'm very excited to teach you all, and I am giving you a commitment that the level of knowledge and the understanding that you will be having in SPMBB will be at a different level after attending the class. Your level of maturity will increase, and we are going to study this subject by touching the practical aspects also. I've seen a lot of lectures of SPMBB in the YouTube, but I think the touching of practical aspects was missing at a lot of places, and the level of conceptual clarity that you should be having at a final level where your subject should be connected with the inter subjects, okay, these were missing. So I'm going to fill those gaps, and you can see the other demo lectures also. So see you on the other side. Thank you very much. This was Thofik Tufel signing off for now. Bye.